After Deutsche Bank's big news over the weekend announcing massive job cuts and an exit of the global equities business, how are the other large cap banks looking ahead of earnings next week? Let's bring in Marty Mosby, Director of Bank and Equity Strategies at Viking Sparks. Marty, thanks for joining us. Good morning to you. I have to start with your reaction to Deutsche Bank. I know you don't specifically cover it, but what's your take and what does it mean for the U.S. investment banks?
Well, really what we're looking at here is that the European banks are having to catch up what we've already seen in the United States, which is a lot of this restructuring, cleaning up the balance sheets, having to look at efficiencies, kind of look at which businesses you can strategically be profitable in. The equities business is just tough. And the exit there will generate a little bit of capacity to be reallocated to the money center banks here in the United States. So that's a positive for them. Deutsche Bank is basically now letting the shoe drop that we saw here in the United States about 5 years ago.
In your experience, can an investment bank successfully exit one part of its business and still see the other parts of its business thrive?
Well, this is we're going to have to see how that's going to work out now. They've always had them kind of pushed together. In other words, you needed equities to make sure you had investment banking. But the two businesses, after we went through all the separation and the Chinese wall, have been much more separate than they were a decade ago. So I think it is reasonable that you can move ahead, especially as you have investment banking, things that you're adding positively, debt raise, equity raise. Those are things that companies are going to need anyway.
Marty, the big U.S. banks start reporting next Monday. What's your expectations for the sector? I guess if this had come 3 weeks ago, the share price setup would have been relatively easy, but they've had a decent performance of the most recent couple of weeks.
They have, and if you look at it, they needed to kind of close the gap with the rest of the market. When you look at what's happening in this sector, the large cap banks, there's typically 3 phases to a recovery. And this recovery just taking way longer than what we've seen in the past. You had credit, which was like the first 3 or 4 years. You then had interest rates, which was really 2015 until now with the transition the Fed's going through. And then lastly, the last phase is the deployment of excess capital and liquidity, which we're now getting. And we had those positive signs as we came back through the capital announcements with CCAR at the end of June. So we are now entering the 3rd phase of this recovery. We've seen profitability, a return on tangible common equity, go from 10% back in 2010 to around 17%. We think the banks can hold that, if not increase it another half point. So we still have some positive catalysts ahead for the group. This quarter is not really going to show much in the sense of earnings. The capital announcements were the big event here in this period of the year.
Is a Fed cut and then a Fed cut cycle positive for the banks, given what it could do to the curve?
Well, what's interesting is it's not as much the curve as it is if short-term rates begin to drop. These banks still are predominantly asset sensitive. So there is a negative to earnings with short-term rates going lower, but we only think that's about 2 or 3%. And so as you're looking at this, inflation has pulled back. I think that's the key factor for the Fed. So if inflation stays around 2%, I think they feel the freedom that they can move back a couple of points, but they don't want to move aggressively in the lower end. So this isn't something that's going to really impact earnings as strong as what we just saw on the capital side that generates a 10% increase in cash flow to bank investors. So while the market's very worried about what's going to happen to interest rates, I think we'll see the impact will be much more modest than what's been factored into the valuations right now.
Marty, we're celebrating the longest economic cycle in history. What are you seeing in terms of credit quality trends?
Well, we actually have a credit cycle monitor that looks at where we're at in the credit cycle. We used it 20 years of managing a bank, and it gave us the foreshadowing of when we're going to see the credit cycle turn. It is one of those fear factors that bank investors have kind of pulled back because they're imagining that the yield curve is telling us that we're going into recession. Right now, our index says that we're in relatively stable or neutral territory. We think that that gives us the all clear for the next 12 to 18 months, although slower growth. So while it's been one of the longest expansions, it's also been one of the slowest that we've ever seen. So when we should have been entering phase 3 of this recovery, 5 or 6 years ago, we're just now getting there. So this has been a slow boil as we've gone through this process, and we still feel like we're going to be stable but slow for the next couple of years.
Marty, what's your top pick going into earnings?
Well, as we're going into earnings season, what we're really looking at is which banks can actually start to redirect investors in the sense that what have they accomplished in changing the way that they've reacted in the past. So what the fears are what's happening in interest rates and what's happening in the balance sheet on credit, which banks are going to be able to prove to investors that they've done the most to change that. Two of those that we really think stand out are Regions Financial, who has changed their interest rate positioning significantly, as well as de-risked their credit side of their balance sheet, and then Zions Bancorp. Similar process that they've gone through there. So those are two banks that have been discounted or pulled back because those factors are anxiety in the market right now, and we think they've changed the dynamic tremendously, and the investors will start to appreciate that in the next couple of earnings seasons.